Hi, I'm David Stein of Money for the Rest of Us, and in this video we're going to take a look at some tax-efficient bond ETFs apart from municipal bonds. Now, I'm a former institutional investment advisor. I'm a mobile professional. I'm recording this video in my sister's barn in New Jersey, so we move around a lot, but we provide investment education. I've been doing that for over a decade on Money for the Rest of Us. Now, traditionally, if you were looking for a tax-efficient way to invest, you would, on the fixed income side, you would invest in municipal bonds because they are exempt from federal income tax. And in many cases, if you're buying a state bond in your home state, then it's tax exempt from state income tax. But the reality is the pricing of municipal bonds is based on a higher marginal income tax rate, oftentimes those in that 35% tax bracket. But if you're in a lower tax bracket, there's times where municipal bonds don't make sense even after you adjust the yields on a tax equivalent basis. And for those in that category, there are actually some brand new options. One that was released a couple years ago, it's the Alpha Architect 1 to 3 month BOXX ETF, ticker is BOXX, and the other is brand new. It's the FM Compounder U.S. Aggregate Bond ETF, ticker is CPAG. Now, these ETFs are different. BOXX invests in shorter term bonds. Essentially, it's actually not investing in bonds at all. It's using an option-based strategy to replicate the returns of 1 to 3 month treasuries. And so it's a cash equivalent. But what's fascinating about it, it doesn't distribute a dividend. It generates that cash-like return via an option strategy, and so it comes through appreciation of the ETF over time. And then when the investor in the ETF wants to realize a gain, then they just sell shares of the ETF. And it's an option-based strategy. It's a BOXX strategy. It's a little complicated. Let me show you one graphic that BOXX put together. They use what's called a BOXX spread by going long calls, short puts, as well as short calls and long puts, and it forms this BOXX spread. Now, you don't have to be an options expert to understand it. You just have to realize that with this type of option strategy, the return due to the time value of money effectively replicates cash. And we can see that in the return of BOXX over time. Let's just take a quick look at the investment returns. BOXX has returned 4.91% annualized since its inception back in early 2023, compared to the Spider Bloomberg 1 to 3 month T-bill ETF, ticker BIL, that's returned 4.84%. So BOXX has done incredibly well tracking the return of cash, but using the option strategy. It's only had one distribution, an income distribution, back in 2024. Right there around August, you can see the price of BOXX dropped, and it actually wasn't an income distribution. It was a capital gain distribution, as BOXX used to implement its strategy using the S&P 500, but now it uses ETFs or options on ETFs. One of the risks with BOXX and with this other, the Compounder U.S. Aggregate Bond ETF, is an IRS ruling that could rule that BOXX and this other ETF, while they might not be generating income, it's effectively a return based on the time value of money. Now, the IRS hasn't ruled against them at this point, but that is one of the risks in terms of sort of this novel strategy to generate income-like returns, but do it generating unrealized gains. So that's the BOXX strategy. It has been very effective. What does the FM Compounder U.S. Aggregate Bond ETF do? Now, this is a brand new ETF with just over $5 million in assets. If we compare it to BOXX, is over $8 billion in asset. The expense ratio of BOXX is 19 basis points. The expense ratio of CPAG is 45 basis points. What CPAG does, in some ways it's a simpler strategy. They will hold underlying bond ETFs that track the broad bond market, the U.S. Aggregate Bond ETF. But right before they're going to pay a dividend, they'll sell it and go into a similar ETF in order to not receive that dividend. And then once the dividend is paid, they'll go back in to the original ETF. Now, the way that bond ETFs work, they own underlying bonds and they're receiving interest income over time, and that increases the net asset value. Then the ETF pays a distribution, an income distribution. It lowers the NAV. And what CPAG is doing is effectively writing up the NAV and then selling the ETF right before the dividend distribution, and then they're buying back in order to continue to ride it up. And what that effectively does, it generates the appreciation, but doesn't receive the income, and so the rate of the return, in theory, because this is brand new, should be comparable to the Bloomberg Aggregate Bond Index, but with all the return coming through unrealized gains. And again, the investor can sell the ETF to recognize the gain. Now, with both of these ETFs, and built into the tax efficiency of ETFs is this share creation and redemption process, where the ETF sponsor can transfer over underlying securities with large embedded gains, low tax cost basis, and essentially move those over to authorized participants as part of that share creation and redemption process. Now, all ETFs can do that, which is why ETFs are more tax efficient than index funds. Now, both of these ETFs will do that, both BOXX and CPAG, but in addition to that, their underlying strategy, either the option strategy that BOXX is using, or the avoiding the dividend by selling strategy of CPAG, that is inherently tax efficient the way they're going about it. Now, fascinating development in the ETF space. The alpha architect, the BOXX, it's working. And the IRS has not cracked down on it. And CPAG, in theory, it should work just based on how ETFs works. We'll continue to monitor that. But it's gratifying that there are actually some options out there, apart from municipal bonds, that you can invest your taxable portfolio in bond ETFs and generate the return through unrealized appreciation rather than receiving the dividend income if you don't want it. You just want the lower volatility of bonds, but without the tax headache that can come with that. And both of these ETFs does that. What do you think? Have you tried them out? What are your thoughts on it? Let me know down in the comments.